Let's talk about these definitional issues. When you talk about building a portfolio of environmentally, social, and governance, not pure, but outstanding companies, what are you looking for exactly? How do you measure it, Valerie?
So we measure it in multiple ways, and actually we look at the underlying data rather than a third-party rating as a way of assessing the portfolio overall. So when it comes to environmental stewardship, as an example, we look at the carbon emissions and carbon intensity of our portfolio relative to the broad market. Our benchmark is the S&P 500. On social issues, we have third-party data that we're able to scrape from sources like Glassdoor. We also look at the Corporate Equality Index, which is a very robust measure of LGBTQ equity practices. And then if you look at the board of directors, we have a lot of data on the composition of the board. 23 different indicators, actually, that we have used to create our own board effectiveness index, which looks at everything from the independence of the board overall and the various committees to the diversity on the board. And so there are a range of different data sources that are available. Some are disclosed by the company, but others are data sources that you have to go out and find in order to create a mosaic.
So, John, I know we're going to talk a lot about this throughout the program. The G in ESG investing refers to governance, and Valerie just talked about board composition and so forth. I want to talk about the composition of the shareholder base and how some companies that might seem on the surface to be ESG companies actually have governance issues in them because they have dual categories of stock where one stockholder is really the controller of the voting shares and others don't have any control there. Can a company that has that kind of governance meet your hurdle for being in an ESG portfolio?
Sure. Well, I think it's really, we would take that on a case-by-case basis. And really, when you get in there and get to talk to management teams and get to know their strategies for success, I think then it will come out in terms of how the unique structure of governance might set up a company for success over the long run. But I think it's important to note that, you know, our approach to ESG is really all about enhancing long-term returns. So at Ariel, we'll invest in companies, some of whom are not ESG leaders, and really focus on working with them to help improve. And we think that that's really the key to success, especially in the small and mid-cap space where there's a lot of room for improvement and investors can play a really
constructive role. I find that very interesting. In other words, a company doesn't, well, number one, does not have to have, it's fine for a company to have dual shareholder classes, I'm hearing you say. That's not necessarily a disqualifier. But also not a disqualifier is a company that would not otherwise meet the standards of ESG, but one which you think you can work with to improve. Have you had demonstrable improvement results when you've done that? And so that those companies that maybe didn't meet the standard now do?
Yeah, I mean, I think, and especially in our part of the market, in the small and mid-cap space, investors have an opportunity to affect real change. And we've seen that over our history. We can count over 50 instances, for example, speaking of governance, where portfolio companies have added diverse directors following Ariel engagement.
Shepard Smith here. Thanks for watching CNBC on YouTube.